You are here because you want to learn about investments, so make sure to watch the entire video to learn. Greetings, Luxo lovers! I hope you're all doing well. In today's video, we're diving into the world of investments. It's crucial that you stay tuned and listen attentively to kickstart your investment journey armed with knowledge. Before we dive in, we kindly ask our Luxo lovers to show their support by liking this video, sharing their thoughts in the comments, and spreading the word to others. This way, we can reach a wider audience. And if you're new here, please consider subscribing to Luxo-Life and hitting that notification bell so you never miss an update. Let's begin by defining investments. Investments are like putting your money to work for you. It means you take some of your cash and use it to buy things or do things that could make you more money in the future. These things you buy or do are often called assets. They can be stocks, which are like pieces of a company, or bonds, which are like lending money to a company or the government. You can also invest in real estate, like buying a house to rent out, or even starting your own business. Let's look at John and Jane for an example. Imagine John decides to invest $10,000 in a tech company's stock. As that company grows and becomes more valuable, the price of the stock goes up. So, John's $10,000 can become more than that over time. Jane, on the other hand, puts $50,000 into a rental property. She makes money from people renting her property, and she thinks the property's price will also go up over the years. Both John and Jane are investors because they're using their money to hopefully make more money down the road, just in different ways. Now that you are familiar with the term investment, let's discuss keeping an emergency fund. What is an emergency fund, though, first? There is a financial safety net similar to an emergency reserve. It is an emergency fund that you set away for unforeseen expenses such as hospital bills, auto repairs, or job loss. It's there to help you cover these unexpected costs without needing to borrow money or dip into your savings. Prior to making any investments, you should have an emergency fund to make sure you're ready for any unforeseen expenses. Consider John and Jane. If John has $5,000 in his emergency fund and Jane doesn't, and they both face a $2,000 car repair bill, John can comfortably cover it from his emergency fund, while Jane might need to scramble for money, potentially incurring more debt or financial stress. It's common advice among financial experts to have 3 to 6 months' worth of living expenses stashed away in your emergency fund. For example, if your monthly expenses total $3,000, you should try to save anywhere from $9,000 and $18,000. This might seem like a substantial amount, but think of it as your financial safety cushion that ensures you can weather unexpected storms without derailing your financial goals. Before you invest, did you know that there is a thing called paying off high-interest debt? It means taking the necessary steps to fully repay loans or balances that come with high interest rates. When you borrow money through loans or credit cards, the lender usually charges you an extra fee for using their funds, which is the interest. High-interest debt refers to loans or credit card balances that have particularly high interest rates, often significantly above the average. Paying off this type of debt involves gradually returning the borrowed money, along with the accrued interest, until the debt is entirely cleared. This is done to reduce the financial burden of interest charges and improve your overall financial stability. Paying off high-interest debt, like credit card balances, should be a top priority before diving into investments. High-interest debt means you're charged a significant extra fee for borrowing money, often more than what you might earn from investing. Think of it as clearing the path for smoother financial growth. If both John and Jane have high-interest credit card debt, it's wiser for them to focus on paying it off first, as this debt can quickly eat into their savings and hinder their financial stability and progress. In addition to managing debt and building an emergency fund, it's crucial to consider retirement planning. Retirement planning means preparing for a time in the future when you may no longer work and need a source of income to support your lifestyle. It's like setting up a financial plan to ensure you have enough money to enjoy your retirement years without financial stress. One key aspect of retirement planning is having a retirement account. These are special types of savings or investment accounts designed specifically for retirement. Two popular options are the 401k and Roth IRA. A 401k is a retirement account typically offered by employers, while a Roth IRA is an individual retirement account that you can open on your own. Opening a retirement account, like a 401k or Roth IRA, comes with several benefits. One major advantage is that they offer tax benefits. With a 401k, you can often contribute money before taxes are taken out of your paycheck, which means you lower your taxable income for the year. Plus, many employers match a portion of your contributions, essentially giving you free money for your retirement. On the other hand, a Roth IRA allows your investments to grow tax-free, so when you withdraw the money in retirement, you won't owe any taxes on the gains. These tax advantages play a significant role in long-term financial planning. By reducing your tax burden or allowing your investments to grow tax-free, you can potentially amass a larger nest egg for retirement. This helps you secure a more comfortable and financially stable retirement, ensuring you have the funds you need to enjoy your later years without worrying about money. It's like planting seeds for your financial future and watching them grow over time. Now let's understand investment by defining the terms of stocks and bonds. Stocks and bonds are two fundamental forms of investments. When you buy stocks, you're essentially acquiring a piece of ownership in a company. Think of it like owning a slice of a big pizza. The more slices or shares you have, the more of the company you own. On the other hand, bonds are like loans you provide to either a company or the government. They issue a bond, and you're the lender. They agree to pay you back the borrowed money with interest over time, somewhat like repaying a loan. Now let's get into how these investments work. When you invest in stocks, you're banking on the company's success. Your stocks may improve in value, and you may be able to sell them for a profit if the company performs successfully. However, the value of your stocks may decrease if the business encounters difficulties or performs below expectations. So, stocks come with the potential for big rewards, but also carry the risk of losing money if the company doesn't do well. Bonds, on the other hand, operate a bit differently. When you invest in bonds, you're essentially lending money. The company or government agrees to pay you back the amount you invested, or the principal, along with interest over a set period. Bonds are generally considered less risky than stocks because you're more likely to get your money back, but the trade-off is that the potential rewards are usually lower. However, they can still provide a stable source of income. Now, about those potential risks and rewards. Oh wait, what is risks and rewards in the first place? Risks and rewards are two essential aspects of investing. Risks are the potential downsides or uncertainties associated with an investment. It's like the chance of something not going as planned, such as losing money on a stock if the company faces problems. Rewards, on the other hand, are the benefits or gains you hope to achieve through your investments, like earning money from a stock's price going up or collecting interest from bonds. Now, about those potential risks and rewards in investing, stocks offer the potential for higher rewards because if a company becomes hugely successful, the value of your shares can soar, leading to substantial profits. But stocks also come with the risk of losing money if the company encounters challenges or doesn't perform well. On the flip side, bonds provide more stability and a predictable source of income through interest payments. However, the returns from bonds are usually lower when compared to stocks. The key is to understand the balance between these two factors in your investment strategy. It's a bit like cooking. You blend different ingredients to create a balanced and delicious meal. In this case, you mix stocks and bonds in your investment portfolio to create a balanced and well-thought-out financial plan that suits your long-term goals and your willingness to take on risk. So why do higher rewards often come with higher risks? It's because risk and reward are interconnected. When you take on more risk by investing in stocks, you have the potential for higher rewards, but you also expose yourself to the possibility of losing money. On the other hand, safer investments like bonds offer more stability but typically come with lower potential rewards. Finding the right balance depends on your individual financial situation, goals, and how comfortable you are with taking on risk. It's like deciding how spicy you want your food. Some like it mild or lower risk, while others prefer it hot or higher risk, but finding the right level of spice is crucial for a satisfying investment journey. Moving on to our next topic is the mutual funds and index funds. They are both ways to invest your money, but they work a bit differently. Mutual funds are like a basket of investments managed by a professional. When you buy into a mutual fund, your money is pooled together with other investors, and a fund manager decides where to invest it. They might pick stocks, bonds, or other assets to try to grow your money. Index funds, on the other hand, are a bit more passive. Instead of a human manager making decisions, an index fund aims to copy or track a particular market index, like the S&P 500, which represents a bunch of big companies in the stock market. So when you invest in an index fund, you're essentially buying a piece of all the companies in that index, and a computer algorithm manages it to match the index's performance. Now let's compare and contrast them. The big difference is in costs. Mutual funds tend to have higher costs because they pay a fund manager to make investment decisions. These costs can eat into your returns over time. Index funds, on the other hand, have lower costs because they're more automated and don't require active management. This makes index funds a favorite of investors like Warren Buffett, who often talks about the importance of low fees. Another important concept to understand is diversification. It's comparable to spreading your financial risks. Both mutual funds and index funds help you achieve diversification, which is essential in investing. Diversification spreads your money across different assets, reducing the risk that one bad investment can sink your entire portfolio. Typically, mutual funds attain this diversification by maintaining a combination of equities and bonds. Index funds, on the other hand, automatically give you diversification because they mirror a whole market index, which already includes a bunch of different investments. So when deciding between mutual funds and index funds, you'll want to think about cost, your investment goals, and how much control you want over your investments. Mutual funds can offer professional management but at a higher cost, while index funds provide a simpler and often more cost-effective way to invest while spreading your risk across various assets. It's like choosing between a chef cooking for you, mutual funds, or following a proven recipe, index funds, to create a well-balanced and tasty investment portfolio. It won't be effective without cost-effective investing. Now listen, low-cost index funds play a vital role in a well-rounded investment portfolio. They align perfectly with the investment philosophy of legendary investor Warren Buffett. Mr. Buffett has often recommended that investors opt for low-cost index funds, and he even made a famous bet to prove their effectiveness. Over a 10-year period, he bet that an inexpensive S&P 500 index fund would beat a group of actively managed hedge funds. Guess what? He won that bet. This supports the idea that index funds can be a smart choice for many investors because they offer broad market exposure at a fraction of the cost of actively managed funds. When it comes to investing in mutual funds, one important factor to consider is the impact of management fees on your returns. Mutual funds typically charge fees to cover the costs of professional management. While having a skilled manager can be valuable, these fees can eat into your investment returns over time. The higher the fees, the less money you get to keep. So it's crucial for investors to be aware of these costs and seek out funds with lower expense ratios. One of the most important tactics to help you optimize your long-term results is to minimize fees. Investors can take steps to minimize fees and boost returns by looking for low-cost mutual funds and index funds. Compared to actively managed funds, these funds frequently have lower expense ratios, which means that a larger portion of your money stays invested and has the potential to increase over time. Additionally, consider tax-efficient investing strategies, like holding investments for the long term to reduce capital gains taxes. Being mindful of fees and taxes is like fine-tuning your financial engine to run more efficiently, ultimately helping you reach your investment goals with less friction and expense along the way. When it comes to investing, it's essential to understand that it's not a short-term game. It's more like a marathon than a sprint. Long-term investment strategies involve a patient approach, where you invest your money with the intention of letting it grow over many years or even decades. This patient, long-term approach can offer several significant benefits. Firstly, one of the main advantages of long-term investing is compound interest. Think of it as the snowball effect. Your initial investment is increased by any returns your money generates from investments. Over time, your investment can grow faster and more substantial because you're earning returns on both your initial investment and the returns you've already earned. Over time, this compounding impact can greatly increase your wealth. Secondly, long-term investing allows you to ride out market fluctuations. The stock market, for example, can have its ups and downs in the short term, but history has shown that it tends to go up over the long run. By staying invested through these fluctuations, you're more likely to benefit from the market's overall growth. A long-term strategy can also lessen the influence of emotions on your investing choices. When you invest with a long-term mindset, you're less likely to react impulsively to market swings or headlines. You can weather the short-term storms knowing that your long-term goals are intact. Lastly, patience in investing can lead to better tax outcomes. In many places, if you hold investments for a longer period, you may qualify for lower tax rates on any gains when you eventually sell. This can be a significant advantage for your overall returns. Now, Luxo lovers, you might be wondering, where do you start? Well, you begin by prioritizing financial education and making smart decisions. By watching this video, you're already taking a step towards educating yourself financially. Returning to our topic of financial education and wise decision-making, consider financial education as your roadmap for your financial journey. It's not just beneficial, it's absolutely essential for everyone. When it comes to investing, learning about it can make a world of difference. There are several resources and tools available to help individuals educate themselves about investing. You can start by reading books on personal finance and investing, like The Intelligent Investor by Benjamin Graham, or A Random Walk Down Wall Street by Burton G. Malkiel. These books provide valuable insights into investing principles. Online courses and websites are also great options. Websites like Investopedia, Morningstar, and the U.S. Securities and Exchange Commission or SEC offer educational materials, articles, and tutorials to help you understand the ins and outs of investing. Many online brokerages also provide educational resources, including webinars and video tutorials. Moreover, don't underestimate the power of financial advisors. These professionals can provide personalized guidance and help tailor an investment strategy to your specific goals and risk tolerance. Just be sure to do your research and choose a qualified and trustworthy advisor. Lastly, take an active role in your financial decisions. Remember that it's your money and your future. Do a lot of study before deciding which investments to make. Recognize the possible risks and benefits of any investment. Consider your financial goals and risk tolerance and create an investment plan that aligns with them. In the world of investing, knowledge is power. The more you educate yourself and actively participate in your financial decisions, the better equipped you'll be to make informed choices that can help you build a more secure and prosperous financial future. It's like being the captain of your financial ship, charting a course towards your goals with confidence and clarity. In conclusion, investing is like planting seeds for your financial future, and we've covered critical steps in this journey. From building an emergency fund and managing high-interest debt to understanding the balance of risk and reward, we've laid a solid foundation. We've also explored retirement planning with accounts like 401ks and Roth IRAs, and the power of compound interest in long-term investing. Lastly, we've emphasized the value of financial education and active decision-making. Remember, financial success is within reach through informed choices and continuous learning. And that wraps up today's video, Luxo lovers. If you found this video helpful, please like, comment, and share it. Don't forget to subscribe to Luxo-Life and hit that notification button so you won't miss our next update. Until next time, Luxo lovers.